Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at GeneDx.
If you find our talks useful, please consider subscribe, like, and comment underneath. And imagine watching a company's stock just completely plummet.
Yeah, like retail investors are in genuine panic.
Yeah.
Just aggressively hitting the sell button.
Right after a really harsh earnings miss. But then behind the scenes, you have one of the smartest hedge funds on Wall Street quietly and aggressively buying up every single share they can get their hands on.
It's the ultimate market divergence, honestly. When you see retail fear clashing directly with institutional accumulation, you just have to stop and look under the hood.
You really do.
And right now, GeneDx is at the center of exactly this kind of intense market drama following their Q1 2026 earnings.
Which means we need to figure out who is actually right here. Is it the panicking retail trader or the hedge fund loading up on the dip? And honestly, trying to catch a falling knife in a stock chart like this, I mean, it's exactly why we look at tools to help manage risk. So before we get into the massive healthcare shift driving this stock, we should probably mention VIP Algos.
Oh, right. Yeah, if you're looking for help reading these incredibly volatile trading charts more clearly, you can check out VIP Algos through the link below in the description.
Yeah, it's a TradingView indicator suite. It basically gives you visual buy and sell chart alerts, trend direction tools, support and resistance zones.
And it gives you areas to plan your take profits and stop losses, too.
Right. And just to be absolutely clear here, VIP Algos is an educational chart analysis tool only. It's not financial advice.
No, definitely not.
It doesn't place trades for you, and there are zero guaranteed profits. Trading involves significant risk, so always manage your risk and, do your own research.
And we also need to acknowledge that it's an affiliate link, right? Meaning we may earn a commission if you use it at no extra cost to you.
Yes, exactly. So let's figure out what is actually going on with GeneDx to understand why a hedge fund would buy into this massive sell-off. I mean, you really have to look at the multi-year healthcare trend happening in the background.
You do, because if you're thinking about putting this in a portfolio, you really need to recognize what it is and, frankly, what it isn't.
Right.
This is not a safe, sleep-at-night dividend stock.
Oh, far from it. Like, you are taking on short-term volatility here because you believe in a systemic shift in medicine. GeneDx isn't just running, a routine blood lab.
No, their thesis is way bigger than that.
Yeah, they are actively trying to take genomic screening, which has historically been this very niche, last resort diagnostic tool, and turn it into a foundational piece of standard medical care. Think about the early days of MRIs.
That is actually the perfect historical comparison to make.
Right, because decades ago, if you went to the doctor, an MRI was considered this incredibly expensive, rare, almost experimental procedure.
Insurance absolutely did not want to pay for it.
Exactly, and doctors only ordered it if absolutely every other test failed. But today, you tweak your knee, and it's the standard of care. It's foundational.
Right, it's step one now.
Yeah. And GeneDx is betting that exome and whole genome sequencing is on that exact same adoption trajectory.
And that MRI comparison is crucial for understanding how their business model actually works. Because what GeneDx does is they sequence exomes and genomes to spot rare diseases.
Right.
Basically, they're reading the foundational biological blueprint of a human being to find the exact typo in the DNA that's causing a severe health issue. And usually this is in children.
Right, which is incredibly important work. And the market demand for finding those typos is accelerating fast. Just look at the numbers from full year 2025.
Yeah, revenue grew 41% year over year, hitting over $427 million.
That's huge. And their core focus, the exome and genome testing, that was up 54%. And that momentum carried right into Q1 2026, where their test volume grew another 34%.
They ran over 27,400 tests in a single quarter.
It's wild. But the reason the smart money is interested isn't just the sheer number of tests being run today, right?
It's what happens after the test.
Yeah.
That is the key. They are building this massive competitive moat called GeneDx Infinity. It is the largest rare disease genomic data set globally.
Globally. Wow.
Yeah, we are talking over 2.5 million patients and 1 million exomes and genomes.
Okay, let's unpack that mechanism a bit, because a big database sounds really nice in a pitch deck, but how does that actually drive revenue and, beat out the competitors?
Well, it creates a classic network effect. See, when you sequence a genome, you get massive amounts of raw data. To figure out if a specific genetic variant is harmless or if it's actually causing a rare disease, you have to compare it to a vast library of other genomes.
Okay, so because GeneDx has the biggest library in the world, their diagnostic accuracy is higher.
Exactly. And they can interpret those results much faster than a smaller competing lab ever could.
So the more tests they run, the smarter the data set becomes. And then the smarter the data set becomes, the more clinical partners and biopharma companies want to work with them.
Which just brings in more tests. It's a total flywheel.
I see. And they're backing that flywheel up with some real muscle on the ground, too. They reportedly have a commercial sales force that is 6 times larger than their next closest competitor.
6 times, yeah.
But wait, hold on. I have to push back here for a second. If the volume is up 34% and the flywheel is spinning and they have this huge sales force, why did the stock just fall off a cliff?
Yeah, that's the big question.
Like, you can't have explosive growth and a massive retail sell-off without a major catch.
And that brings us to the harsh reality of their Q1 2026 earnings report. Because despite running all those tests, their total revenue came in at $102.3 million, which entirely missed Wall Street's expectations.
Ouch.
But it's worse. They posted an $8.2 million adjusted net loss and a staggering $63.3 million GAAP net loss.
Okay, let's translate that for a second so we know exactly what we're looking at. A GAAP net loss, meaning generally accepted accounting principles, that is, the official fully loaded bottom line.
You're right, the real number.
Yeah, it includes all the messy expenses like stock-based compensation and depreciation of assets. So legally on paper, they lost over $63 million in a single quarter.
Right, and if that wasn't enough to spook the market management, then slash their full year 2026 revenue guidance.
Which is never what you want to hear.
Ever. They had previously told investors to expect between $540 and $555 million for the year. They dropped that target down to a range of $475 to $490 million.
Okay, well, that completely explains the retail panic. I mean, if a high-growth company suddenly says, actually, we're going to make $60 million less this year than we originally promised, the market violently reprices the asset.
It does, but we have to look at the balance sheet to see if the company is actually fundamentally broken or if they're just stumbling through a growth phase.
Right.
Because as of March 2026, they still maintain a very solid $171.7 million in cash and marketable securities.
That's a good cushion.
It is. And interestingly, despite the revenue cut, management is still guiding for roughly 70% adjusted gross margins for the year.
Wow, 70%. Which means for every dollar of testing they sell, it only costs them about 30 cents to actually perform the test in the lab.
Exactly.
That leaves 70 cents to pay for the rest of the business overhead. That is basically a software-like margin for a healthcare lab.
Precisely.
Yeah.
And they are using that cash buffer to fund a very aggressive commercial expansion. In early 2026, they tripled their sales force. They jumped from 50 reps to roughly 150.
Okay, so where are they sending all these new reps?
Their target is to push beyond just rare disease specialists and get into general pediatrics and the prenatal market.
But if they really are expanding that fast, they need a serious catalyst to turn this narrative around. I mean, how do they actually fill the pipeline for 150 new sales reps? You can't just knock on a pediatrician's door and demand they order an expensive genome test.
You can't. But they are riding some massive regulatory tailwinds right now that open those exact doors for them.
Like what?
Well, recently the American Academy of Pediatrics, the AAP, updated their official guidance. They are now recommending exome and genome sequencing as a first-tier test for children presenting with global developmental delay.
That is huge for the parents of these patients. To go back to our analogy, that's like a medical board saying, don't do a basic x-ray, don't do an ultrasound, go straight to the MRI.
Right, it removes all that friction.
Doctors don't have to fight insurance companies through 5 cheaper, less effective tests before they're allowed to sequence the child's genome to find out what's wrong. It just becomes step 1.
And that structural shift is happening across the board.
Yeah.
There are major ongoing initiatives right now, like the Beacons and Guardian studies.
What do those look at?
These are systemic trials proving the clinical utility of sequencing newborn babies right at birth. It's all driving toward this technology becoming standard care, which directly feeds those new sales reps.
But those are macro trends, right? Like, they take years to fully play out. What is the immediate make-or-break moment for GeneDx as a stock?
Q2 2026 earnings expected this August.
Okay.
That is the proving ground. The market needs to see if those 150 new sales reps are actually generating high-margin volume in the field or if they're just burning through that cash pile.
Right.
We also really need to see if the reimbursement rates meaning what insurance actually pays them, have stabilized.
And while we wait for those hard numbers in August, there's another kind of speculative catalyst brewing in the background, right? Something involving big pharma.
Yes, this is the upside surprise potential. There is heavy industry chatter about GeneDx potentially announcing multi-year data licensing agreements.
Oh, with the data set.
Exactly. Remember that massive GeneDx Infinity data set? Over 2.5 million patients. Pharmaceutical companies desperately want access to that data for drug discovery.
Because if you're a pharma giant trying to invent a drug to cure a rare genetic disease, having access to millions of mapped genetic blueprints is an absolute goldmine.
It's invaluable.
If GeneDx can monetize that data moat, that is pure high-margin revenue, that could completely shift the story overnight.
But until those catalysts actually hit the wire, we have to deal with the reality of the price action.
The brutal downward price action. I mean, when management cuts guidance by $60 million, the chart looks like a cliff. But you mentioned earlier that institutional analysts think the selling is mathematically exhausted. What does that actually mean for the chart?
It means the stock might have hit what we call an oversold psychological support level. Essentially, every investor who panicked and wanted to sell has already sold.
The selling pressure just dries up.
Exactly. And we saw a hint of this shifting momentum on June 23, 2026, when the stock actually traded 5.1% higher.
Yeah, sounds like a basing pattern.
Spot on. A basing pattern is when a stock stops falling violently and starts trading sideways. It's building a base or a floor, which often precedes a relief rally.
And this is exactly the kind of wild volatility where you can't just guess where the bottom is by staring at a simple line graph.
No, you really can't.
Which ties perfectly into why we mentioned VIP algos earlier. When you have a massive gap down in price, you need to identify those structural support zones and use momentum indicators to see if that base is actually holding or if it's just a fake out before another drop.
Right.
Having a visual workflow is critical to managing risk in a setup this volatile.
Which brings us to the most fascinating divergence in this whole story. The chart looks scary and retail sentiment is incredibly fearful, but the institutional side, the big money, they are incredibly bullish.
Yeah, let's look at the analyst targets.
Yeah.
Guggenheim recently maintained their buy rating and actually raised their price target on the stock to $74. And Piper Sandler maintained an overweight rating, which is basically Wall Street speak for a buy, and they raised their target to $63.
And then you follow the actual flow of money, right? There was a small insider sale reported about $227,000, but that is just a drop in the bucket compared to the dominant accumulation story.
Which is hedge fund manager Eli Kasdan.
Yes. He has been aggressively loading up on shares. He is treating this post-earnings panic as a massive buying opportunity.
He sees the 150 sales reps in the data moat, and he's clearly just ignoring the Q1 miss.
There's also a leadership dynamic stabilizing that institutional confidence, too. The company recently appointed Mark Gardner as president specifically to lead this next phase of scale and growth.
Okay, so bringing in some experienced operational leadership.
Yeah, it signals to Wall Street that they are shifting operations to get their business fundamentals in line with their massive technological advantage.
Okay, so the hedge funds are buying, the analysts are upgrading, and the regulatory tailwinds are really strong. But we have to play devil's advocate here because that Q1 revenue miss happened for a very specific reason, and frankly, it could happen again.
It absolutely could. The entire reason they missed expectations wasn't a lack of tests. The volume was up.
Right.
The problem was a lower blended average reimbursement rate.
Let's translate that so we understand the exact mechanism of the risk here. A lower blended average reimbursement rate simply means that even though they're running more tests in the lab, the health insurance companies are negotiating to pay them less money for each individual test.
Doing more work for less pay.
Exactly. Doing more work for less pay per unit.
Which is the ultimate danger of expanding rapidly. They're moving heavily into broader Medicaid markets.
I
But
see.
if Medicaid yields poor per-test economics, or if private insurers keep pushing back aggressively on pricing, their margins are going to stay compressed. And it won't matter if they run 1 million tests a year if the unit economics are fundamentally broken.
Right. And compounding that margin pressure is a very real legal overhang. Because the stock price dropped so violently after they slashed guidance multiple securities, law firms have launched class action investigations.
They are looking into alleged misstatements. The argument is essentially, did management know the reimbursement rates were falling when they gave us the original higher guidance?
And whether the lawsuits have merit or not almost doesn't matter in the short term because it just creates a massive distraction. Legal battles drain capital, they drain executive focus, and they guarantee wild price swings as new headlines come out.
It's a serious risk.
Yeah.
But, to keep a balanced view here, you have to weigh that against management's actions.
Right.
The fact that they are committing to maintaining those 70% adjusted gross margins for the full year suggests they believe this reimbursement issue is temporary.
Just a speed bump.
Yeah. They might just be dealing with short-term product mix issues as they onboard a flood of new clients rather than a structural collapse of their pricing power.
Okay, so we have explosive volume growth, an unmatched data moat, and heavy institutional buying, stacked up against severe margin pressure, slashed guidance, and looming class action lawsuits.
It's a lot to weigh.
It is. So with everything on the table, what is the final verdict?
Well, based on the research, the bottom line is a bullish score of 8 out of 10.
8 out of 10, okay.
The investment rating sits at moderately bullish to strong bullish, but specifically structured as a multi-year hold looking out 12 to 24 months.
Walk us through the summary behind that 8 out of 10 score.
Sure. Despite the guidance cut and the resulting retail sell-off, GeneDx remains the absolute dominant player in this space. They have a 34% volume growth rate and an unmatched data moat with GeneDx Infinity.
The moat is huge.
It is. The market appears to have overreacted to short-term reimbursement headwinds. It presents a highly interesting play for long-term investors who are willing to wait for that expanded sales force of 150 reps to mature.
And for those lucrative biopharma data partnerships to potentially materialize.
Exactly. But on the flip side, because of the legal overhang and the unanswered questions around insurance reimbursement, it remains highly risky for short-term traders.
Which is a clear reminder that this analysis is not financial advice. We aren't telling you to buy, sell, or hold. You have to weigh these risks against your own portfolio strategy.
Absolutely.
And if you are trying to navigate that short-term risk, having a cleaner way to read trading charts is essential. You can check out VIP Algos through the link below in the description.
It's a TradingView indicator suite featuring visual buy and sell alerts, trend direction tool support, and resistance zones and areas to plan your take profits and stop losses.
Just remember, VIP Algos is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it certainly does not guarantee results.
No, definitely not.
Trading involves risk, so always do your own research and manage your risk. And again, that is an affiliate link, meaning we may earn a commission at no extra cost to you.
And if today's analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.
And as you close out today, just think back to that MRI analogy. Every single standard of care we trust today, from X-rays to MRIs, was once a radical, expensive new idea fighting tooth and nail for insurance coverage. The question isn't really whether genomic sequencing becomes the medical standard of the future. The question is whether you have the stomach to handle the volatility while it gets there.